What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. In today's video, we're going to take a look at some of the biggest trades from the Wallstreetbets forum over the past week, so we can learn from other traders' experiences. First, we have user Unhappy Dish, who's not having a great day in the stock market. He posted a screenshot of his Robinhood account showing a 101.25% or $46,000 one-day loss. After recording this loss, he now has an account balance of negative $575.76. This is equivalent to an ordinary person's life savings being flushed down the drain over a matter of just a few minutes. This Wallstreetbets user was all in on Levi Strauss stock, holding 6 different call option positions all expiring on July 16th. His strike prices range from $30 to $34. Levi is an American clothing company best known for its jeans. He posted a lengthy explanation of why he thought it was a good idea to go all in on Levi FDs. He reasoned that with pandemic-related stay-at-home orders over the past year, many people will binge on comfort food at home. With limited opportunities to exercise, most people will gain weight. People's old pants will no longer fit them and they will have to buy new jeans, which will benefit Levi. He loaded up on short-term call options in anticipation of the earnings release. Levi reported earnings that crushed analyst expectations on both revenue and profitability. In response, the stock immediately popped 5% and things were looking great for his YOLO. Despite the earnings beat, Levi's stock drifted downwards over the next day. Fears of the new Delta COVID variant dragged down much of the clothing industry. On Friday, July 9th, Levi closed at $28.38, leaving even his lowest strike price of $30 almost 6% out of the money. Levi is a low volatility stock, and now that earnings are in the rearview mirror, there are no new catalysts that could push the stock higher by July 16th when his options expire. The post-earnings IV crush caused his positions to tank, and his portfolio lost more than 100% of his value. He likely used Robinhood Gold margin to buy positions in stocks. When the value of his calls tanked, taking his equity position to be negative, he got a notice for an account deficit. Fortunately, he had the funds to cover his account deficit by depositing more cash into the money furnace that is his Robinhood account. In light of his account's total loss, the OP has decided to change his investing strategy going forward. He will use pre-IV crush out-of-the-money call options more sparingly in favor of deep in-the-money calls which have lower vega. We wish you luck on this new strategy. Next we have user Kato63, who posted an incredible $24,000 gain off a base of only $1,000, all in the span of a single day. This Robinhood trader owned 2 contracts of out-of-the-money calls on the company Stamps.com. Stamps.com was trading at about $197 a share on Thursday, July 8th. With this trader's $202.5 strike calls expiring the very next day, it wasn't looking good for his position. The calls were about 2.5% out of the money with only 1 day till expiry, and since Stamps.com is usually a relatively non-volatile stock, the probability that the calls would expire in the money was low. However, that all changed with a piece of news that came out on Friday morning that saved this trade. It was announced that the private equity fund Thoma Bravo will be taking Stamps.com private for a total consideration of $6.6 billion in cash. That means that each share of Stamps.com will be exchanged for $330 of cash, with the transaction expected to close within the next several months. With the promise of each share being converted to $330 of cash, naturally the price of Stamps.com stock shot up on the news, most recently trading around $324 a share. With the OP's $202.5 strike price, that puts his calls more than $120 in the money, for a total profit of $24,000. The timing of this trade was impeccable, with his expiry date literally 1 day after the deal was announced. This prompted one commenter to suggest that he should be investigated by the SEC. But someone responded to that comment saying that a $24,000 trade would not concern the SEC. If it were $2.4 million, then the SEC might be interested. But then, if he made $2.4 billion, the SEC would go back to being uninterested in investigating the trade. It is pretty incredible how good the timing of this trade was. It looks like this trader's portfolio needed the lucky break, since his all-time chart was nearly going to zero. But now, he's up 632% all-time, with one of the most epically timed trades since Deep Effing Value. Congratulations on your gains. Next off, we have user DVDR1029. This Wallstreetbets user started investing in early 2021 at about the same time as the GameStop short squeeze. He invested mostly in meme stocks that were popular on Wallstreetbets. While he doesn't go into detail on which stocks were behind his investment declines, he says that he made many plays and had many failures. From what we can see, his account increased in value at about the same time as GameStop, so he almost certainly was in on that. Unfortunately, he mainly did options plays and failed to take profits. Thus, almost all of his profits evaporated due to theta decay. To date, he is down 93%, or more than $12,000. One of his most recent positions was $14 strike calls on Clover Health, expiring on July 9th. Unfortunately, the stock closed at $9.27, causing a total loss on his position. He also owned $85 strike calls on Micron, expiring the same day. While the company has benefited from the chip shortage, the $85 strike price proved to be overly optimistic. This position also ended in a total loss as Micron closed at $78.74 on the expiry date. The downfall of this Wallstreetbets user's account can largely be blamed on options YOLOs with overly aggressive strike prices. We wish you luck on your future plays. Next up, we have a Robinhood trader who has only experienced the stock market going up and to the right. User Kevin3874 has seen his portfolio over the past month going in a beautiful exponential curve upwards, with very little volatility compared to the overall positive trend. He holds a combination of stocks and call options of various strikes, heavily weighted towards the S&P and large-cap stocks such as Apple. In particular, all of his calls are on S&P 500 ETFs, although he for some reason split the trade between SPY and VOO. VOO is another S&P 500 ETF that has gone pretty much straight up for the past several months. It now trades around $400 a share, which also happens to be the strike price of his calls. When a stock increases above the strike price of a call and goes from being out of the money to in the money, that is the time when the percentage gains of the calls are the greatest. Along with strong gains by Apple, the OP's portfolio has skyrocketed in a straight line up by 50% in less than 1 month. That brings his gains up to $10,000 off a base of less than $20,000. Congratulations on your winning trades. Next, we have a Virgin Galactic bull who went all in with $10,000 worth of calls on SPCE. On Thursday, July 8th, one day before expiry, he held 74 contracts of calls on Virgin Galactic, with various strike prices ranging from $50 all the way up to $60. Following a strong performance in Virgin Galactic over the previous several days, he was up $6,000 or 170% on his original investment in the options. He made this post saying that he is going to hold these calls, but is very nervous about how they will do at expiry. If Virgin Galactic were to close below $50 a share on the next day, not only all of his gains, but all of his original capital as well would be wiped out. Unfortunately for the OP, that is exactly what happened. After a weak open on Friday, July 9th, the day of expiry for all of his calls, Virgin Galactic slowly bled out before closing at a little more than $49 a share. That just barely put his lowest strike price out of the money. Hopefully, he sold at least some of his calls before expiry, otherwise he would have lost his entire investment. In response to this post, one commenter says that he sold some of those same options on Virgin Galactic. Even though he is on the opposite side of the trade as the OP, he also did not sleep well the night before. Although the calls expired out of the money, they easily could have gone up even further, maybe even to $60 or more. In this case, anyone who sold calls on it would have had massive liabilities. This just goes to show that when it comes to short-term near-the-money options, the difference between a winning trade and losing everything can be a matter of less than a day. Alright guys, that wraps it up for this video. If you like this content, don't forget to like, subscribe, and share. If you want to support this channel, you can consider becoming a channel member. Members get access to our backlog of videos before they are released to the public. They also get to vote on some of our video topics. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.